All right, so in this video, I'm going to talk a little bit about adjusting for risk. So up to this point, I've talked about the weighted average cost of capital, and that being the rate of return that a firm needs to earn across all of its investments, sort of keeping risk constant, basically. And that's sort of how we would just judge projects and things, on average, if I keep risk constant. So at this point, basically, what I'm going to do is I'm going to remove that assumption that we're keeping risk constant. And basically, what we're going to say is, okay, projects realistically have all kinds of different risks. So now what do we do? So the firm's overall weighted average cost of capital really may only be used to evaluate a project or judge a project if the project has exactly the firm's average level of risk, which is not going to be that common. So let's kind of talk about what happens in a couple of different circumstances. So if the project has a higher level of risk than average, then basically we have to add a risk premium on, and basically we have to add that onto that weighted average cost of capital to produce the risk-adjusted cost of capital or hurdle rate. And keep in mind, when I'm saying it has a higher level of risk, it means that basically this project, when added to my company, essentially increases the risk of my company, and that's why it is a higher level of risk. If I had a situation where the project itself was high risk, but when added to the company, actually diversified my company in meaningful ways and led to my company becoming less risky, then it would actually feel like a less risky project to me, even though the project by itself may have looked risky. So when I'm saying higher and lower levels of risk, I'm looking at the impact upon the risk of the company that the project has. So if the project is going to increase the risk of the company as a higher level of risk, then I have to add on a risk premium and say, all right, weighted average cost of capital might be here. We need to get more than that, right? And so that's going to give us a risk-adjusted cost of capital or a hurdle rate that I will then use when judging that project. If the project has a lower level of risk, or in other words, it would be expected to reduce the risk of my company, then the appropriate risk-adjusted cost of capital or hurdle rate would actually be lower than the weighted average cost of capital. Now, that might actually lead to an interesting question, which would be, well, wait a minute. So if the appropriate hurdle rate for a low-risk project is 10%, when the weighted average cost of capital is, say, 12, how do investors get their required return? I mean, like how does that work? Like if the weighted average cost of capital is 12, we got to earn 12 to get everybody happy. But then this thing is a low risk project, but it only gets 10. But I thought we needed to get 12. What's happening? Well, to see what's driving this is we need to look at the bigger picture. So a firm is basically a giant collection of investments, investments in property, equipment, machinery, marketing activities and plans, and all kinds of things. So basically, all of those are basically investments that affect the risk of the company as a whole, and therefore affect the return that investors are requiring. So if I have a low risk project that basically, given its low risk relative to my business, I really only need to get a 10% rate of return. Basically, what that's saying is the 10% rate of return is okay because it changes what investors require. So here's a way to think of it. What if we just did a load of these projects at 10%? If I did a huge number of these projects at 10%, basically my entire company's risk profile would change. And if my entire company's risk profile would change, it would shift down to having the risk of that project, that required rate of return of 10%, and lo and behold, 10% would be fine. So when you're looking at it, the temptation is just to say, well, 10% is less than 12, this is a problem. But the reality is that's losing sight of the fact that basically that project is lowering the risk of my firm. And as a result, it's okay that it only gets 10% because given the risk of this specific investment, that's an acceptable rate of return. Now I have a graph that kind of illustrates some of this, or a plot. So here's the basic idea. If I'm looking at risk on the x-axis and I'm looking at return on the y-axis here. So for my firm, if I find my firm's level of risk and I look at my weighted average cost of capital, then that's basically the rate of return my shareholders and other lenders and everybody else needs to earn overall as a group relative to the risk of the entire firm, right? Now, this solid line that I have here is a risk-return trade-off. And basically what it's showing is for higher levels of risk, we need higher levels of return. Now, if you're thinking that line looks an awful lot like the security market line, you're catching on. That's the same kind of idea, same concept. So what that means then is I can't use this weighted average cost of capital as the threshold when judging all projects. Because if I looked at a project right here, it is promising a return that's higher than the weighted average cost of capital. But given the risk, I should be requiring more. And therefore, this project that's over here, even though it has a higher than the weighted average cost of capital rate of return, it does not have enough return relative to the risk. So basically what it means is I need projects that are on the line or above the line to look attractive. But similarly, if I find a project over here, this project is actually below the weighted average cost of capital. And our first gut reaction might be to say, well, that's not going to be acceptable. But if I look at the risk level, based on this risk return trade-off, this project is promising much more return than the level I would actually be comfortable with. So I'm getting more than I require, which means I'm okay with this. This would be good. Even though the project is less than the weighted average cost of capital, because it has a less risk compared to the firm as a whole, I'm okay with less return. And this risk return trade-off line says, as long as I'm over that line, it's good, right? Which also means anything below the line is bad, right? So anything below that solid line would be a bad project. Anything above the solid line would be a good project. But ultimately, when I judge projects, I don't just use that weighted average cost of capital. I adjust relative to the risk, okay? So whenever you're evaluating a project, make sure you're using the appropriate risk-adjusted cost of capital when making the assessment about whether or not the project has enough return to justify accepting the project. Hopefully this video has been helpful. Thank you so much for watching and have a great day.